and tax divided by capital employed into 100, and the return on capital employed, return on equity is profit after tax divided by share capital and reserve, that is divided by equity. Efficiency ratios: asset turnover is revenue over asset, non-current asset turnover is revenue over non-current asset, inventory days is closing inventory divided by cost of sales into 365, receivable days is closing receivable divided by credit sales into 365, and if you don't have the credit sales, then you can take the total sales. Closing payable days is closing payable divided by credit purchase, and credit purchase, if the credit purchase is not available, then you can use the cost of sales into 365. Capital structure ratios: debt to equity is debt to over equity, debt divided by equity. Gearing ratio is debt divided by capital employed, and then interest cover is operating profit over finance cost. That will tell you how many times more your operating profit when compared with the finance cost. Liquidity ratios are the current asset ratio, which is current asset divided by current liability. Quick asset ratio is current asset minus the inventory divided by current liability. Investor ratios: dividend payout ratio is total dividend divided by profit for the year into 100. Dividend yield is dividend per share divided by share price. Earning per share is profit for the year divided by the weighted average number of shares. Price earning ratio, which is the key ratio to judge the future prospects of the company, and which is share price divided by earning per share. Please note that the value of EPS is more on how you interpret the PE ratio. If a PE ratio for one company is higher than the PE ratio of another company, what it means is that company has better future prospects. Also, it's subject to lower level of risk. So if the PE ratio is given, please note that your main focus should be on PE ratio. Please note that, unless of course you notice that the PE ratio may be that, hyped up for whatever reasons. Then this is what I told you about the storyboard. You take the question, you divide that into different group, the user group, the change in the P&L, change in the balance sheet, and other important changes, and then you can write the story in the middle. If I quickly do that for one question, it will be easy for you. Several years ago, on leaving on university, F, J and K set up a business. FJK designing and manufacturing furniture for sales to retailers. FJK was established by F and J, each took 45% of share capital, with K holding remaining 10%. So other two are 45% and K had 10%. And this remained unchanged. F and J have always worked full time in the business, remaining as sole directors. K's role was initially part-time, but after the first 2 years she transferred to full-time work in her own consultancy business, so she is not now involved at all. Her contribution to FJK in recent years has been limited, occasionally providing advice. The relation between three shareholders have remained good, but all three are so busy that K rarely meets the others. So you are looking at a scenario that she doesn't have a lot of information as to what is happening. FJK has been successful, and in February each year, with exception of 2008, have paid a substantial dividend to its three shareholders. So except the last year, they paid good dividends. K's consultancy business has also been successful, and she now employs 20 staff. You are a K's financial advisor. During 2006, the two directors decided to expand FJK's international sales by establishing sales force in 2 neighboring countries. So they expanded. By early 2006, orders were starting to come from new countries. Expansion strategy has been very successful. They say it is successful. K attended a meeting with Fay and J to discuss the future of FJK. And Fay and J explained that business now requires more capital, so they are looking for more capital in order to fund further expansion. And purpose of the meeting with K was to request her to inject a capital of 250,000 into the business. Now hold on, she's an outside at the moment. She's a shareholder, but she's not really coming into the company every day. So you have other two investors asking money from her, so she'll be definitely concerned, right? And she's provided with an income statement, which is actually an unaudited statement. Please note that. And let me just take to the income statement, and if you can immediately notice that the profit figures have gone up, revenue figures have gone up, so you don't need ratio calculations. You really can say that, look, all profitability ratios looks good, the turnover has gone up. Moment you see this, check the working capital, because there can be an overtrading problem. And if you look at the balance sheet, look at the share capital, it's only 1,000. That tells you it's undercapitalized. Look at the cash balance, no cash. Look at the property, plant, equipment, massive increase, right? But look at the long-term borrowing and long-term source of finance, no issue of shares. So this is an undercapitalized company and facing an overtrading problem. Why is it? Look at the loans and borrowings that has gone up, and look at the trades and other payables have gone up significantly. So this tells you there is an overtrading problem. So to spot this, you don't need ratios. So once you spot this story, what you can do is can write the report in that particular line. How do you solve an overtrading problem? You have to bring in new capital. The only thing that she is going to demand and say, if I am bringing new capital, it's important that you too also bring in the additional capital. That's the only way that you can sort out an overtrading problem. Also, don't forget, overtrading is an issue out of mismanagement, which is not going to make her very happy. So with that, we'll take a commercial break. We will take a commercial break, and when we come back, we look at the other areas of your syllabus. Thank you very much. Welcome to the final segment of our program, and in this segment I will cover the other small areas of the syllabus. If I start with the first other small area, IAS 33. IAS 33 earning per share involves calculating the basic earning per share under three different possibilities, or three possible scenarios. One, when company issues shares at full market price. Second one is when company issues shares at a bonus issue, and then third one is right issue. And as you know, the basic EPS is earnings divided by weighted average number of shares. In the case of share issue at full market price, let's go through this small example. As at 1st January 2000, ABC had 200 million shares during the 200 million shares. During the year ended 31 December 2008, two share issues were made at full market price. 1st April 2008, 50 million shares, and 1st July, 75 million shares. Consolidated profit after tax and minority interest for the year ended 31 December 2007 is 650 million. Calculate the EPS for 2007. Now to work out the EPS, please note that we need to do the time apportionment for the new issue of shares at full market price. You had 200 million shares at the beginning. 1st April you had added another 50, so it becomes 250. 1st July you added another 75 million, so it becomes 325. So it remains at 325 after that. So for the first 3 months it is 200 million shares. For the next 3 months it's 250 million shares. For the next 6 months it is 325 million shares. So the weighted average number of shares is 200 into 3 over 12, 250 into 3 over 12, and 325 into 6 over 12. That gives you 275 million shares. So therefore the earning per share is earning of 650 divided by 275, which gives you 236 cents per share. In the case of bonus issue, please note that bonus issue do not involve any money coming into the group. So therefore the adjustment would be done in this way. We'll assume as if these shares were there throughout the life of the company. So that is the period before the issue of bonus, and obviously it's period after. So if I take a simple example, T Limited has 4 million shares in issue as at 1st January 2001. On September 30th, the entity made a bonus of 1 for 4. Earning for the year ended 31 December 2001 was 500,000. Calculate the EPS for 2001. Now, in order to calculate the EPS, I need to work out the total number of shares after the bonus issue. Now, every 4 shares you are getting 1 bonus. So you have 4 million shares divided by 4 into 1 will give you 1 million bonus shares. So the total number of shares after the bonus issue is 5 million. So the EPS will be 500,000 divided by 5 million, which is 10 cents. Right issue. With right issue, what happens is that you are issuing shares to the existing shareholders at a discounted price, which means it's a combination of issuing shares at full market price and bonus element. So please don't forget that you need to quantify the bonus element every time you have a right issue.